let's dive into this head on together. And here's our take. All right. So home prices have declined slightly to start off 2025. But here's the thing, it really doesn't matter for buy and hold investors. For this strategy of buy and hold, it really doesn't matter. Um,
Who does it matter for?
what I would say is it matters. So sure, it matters if you are here to flip properties, if you are an owner occupant and you might need to leave for something, a job or a family change or something, and you need to sell today. Sure, that definitely can matter. But that's not who our audience
That's
is.
not the thesis we all buy
Right.
into.
And the challenge is that those narratives get thrust upon our community or our strategy, and it really is not nearly as important. And that, when I say it doesn't matter, of course, it always matters. That's why we're talking about it here. But what I'm trying to reinforce with you is it's not nearly as important as you may think. And we're going to talk a little bit about why.
Yeah, I see it kind of like you go to Google Maps and you're trying to find your directions, and there might be like a detour at some point, but you're still on the route to where you're going, right? Like you still got plenty of gas, you're gonna get there.
100%.
All right, so cool. So let's talk about what does matter.
Well, I just want to set the stage here for how unique it is for home prices to actually have a decline. And again, we are about halfway through the year, so there's another half of the year things could change. But if this plays out the way it is, this would be very, very unusual. So home prices in Jacksonville, Florida have appreciated 88% of years going back from 1982 all the way to 2024. So to think of this being a year where home values decline would be unusual. And this would be the only year outside of the Great Recession years in the last 40 plus years that this happened. So very, very rare and unique. And when we're looking at just why this happens, we have to understand that a combination of influences, of extenuating circumstances come together in order to deliver negative home price appreciation or price declines. It's not normal. Normal is home prices going up, right? So we have to think about those extenuating circumstances. And you can ask yourself, do we have enough extenuating circumstances in 2025 for home prices to decline for the rest of this year in Jacksonville? My answer is maybe. Maybe.
Yeah.
I don't know.
Yeah.
But what I can tell you is that we have to look at the specific extenuating circumstance. Not all extenuating circumstances are created equal, right? We had a lot of extenuating circumstances in the Great Recession that took a long time to unwind.
Yeah.
We need to be thinking about what is the extenuating circumstance in 2025. What's the extenuating circumstance, Pops?
Higher interest rates longer than we have like any collective memory of.
100%.
Yeah.
Higher for longer interest rates. And we also have to remember what happens when you have high interest rates.
Yeah.
They push back current home sales. It delays home price appreciation that otherwise would have happened. So the longer that we have high interest rates, the more home price appreciation is delayed, and the stronger home price appreciation will come back when interest rates come down.
I see it as when you have the low interest rates, it's like it extends, like it pulls in demand, like the coil springs out, right? Like when you have these like longer periods of high interest rates, the coil keeps getting tighter and tighter and tighter, which then would make a bigger bounce when it happens. Right? Is that kind of how
Absolutely, that's absolutely true.
I have a way with
You do. You do. You understand this coil thing. It's so good.
you got extenuating down, I got coiled down.
Well, I think you're right. Okay. So nobody would have expected these interest rates to be here for this long. And what it's doing is it's pushing back home price appreciation and pushing back home sales. So how do we know this? Well, this is where I get to bring in some data and then sprinkle in some of this perspective here. So I went back to the last time that we had interest rates spike like this. And luckily, we do have data back in the early 80s. And so I wanted to share this with you. This is when sometimes you find data that just supports your thesis so well, and it's just uncanny how close the comparison is that it just puts a big smile on your face as a data nerd. And that's kind of what I found here. So back in 1980 to 1982, we had interest rates spiking. And we also found that U.S. home sales dropped sharply. What do you know? So take a look at some of this data. So in January 1980, our starting interest rate for a 30-year mortgage was 12.9%. 12.9%, by the way. It went way up from there.
Yeah.
And for all of you who were owning homes in the early 80s, I'm sure you can speak to this, right? We had a max interest rate for 30-year loans at almost 19%. Crazy. Interest rate ended at 16.6% in August of 1982. Well, what do you think happened with home sales when high interest rates were here?
They dropped 32% is my guess.
That's a really good guess. You know the early 80s very well. All right. So from 1982 to from 1990, excuse me, 1980 to 1982, I'm getting excited here. We saw a 32% drop in US home sales. Well, history has repeated itself because in 2022, interest rates rose from about 3% to about 7%. And guess what? US home sales dropped 31% from 2021 to 2023.
Uncannily similar numbers.
Uncanny.
Duration, magnitude of raise, magnitude of drop on sales. Incredible.
History is repeating itself.
Look at you, data nerd.
How about that, right? So then we need to think about what's on the other side of high interest rates. Well, from 1982 to 1984, once the interest rates declined, guess what? US home sales spiked and home price appreciation increased. So from 82 to 83, interest rates went down from 16.6% back down to the really low interest rate of 12.6%.
Steal.
And home sales spiked 38% from 82 to 83.
Barbara Mershon says she thought she hit a gold jackpot in 1984 when she got a 14%.
Yeah, exactly. You know, it's all relative, right? It's all relative. Well, it really is. But, you know, what is very clear is that interest rates spike home sales or depress home sales, depending if they're high or low. And this also brings home price appreciation back. So we had 4% home price appreciation from 82 to 83. Now, this is across the entire US, so it's very hard for you to see incredibly high spikes. But this was 29% more home price appreciation than we saw in the previous year. So 4% home price appreciation. And guess what? Go ahead.
The coil springs.
There you go, the coil springs. And it's spraying even harder and higher the following year. This is interesting because from 83 to 84, interest rates kind of stayed the same, right? It started 12.6, ended at 13.1. So nothing really moved that much as far as interest rates, but home sales continued to increase and home prices gained another 4.8%, which is actually a 20% gain from the previous year. So home price appreciation was delayed and came back stronger.
The power of the tightly wound coil, you know, now springs beyond just the time period of like the first thing, right? Like once it starts going, it really unwinds because it's been bound so tight.
Exactly.
Yeah.
Exactly.
Okay.
So that's what we're seeing here. And that's the answer to why is it a good time to buy in a high interest rate environment? It's because we're simply pushing back home sales right now. And we're pushing back home price appreciation that otherwise would happen, especially in a market like Jacksonville, which has a growing population. But if you could go back to 1982, and I don't know what people were saying in 1982, but I would imagine the media was talking about how home sales have fallen off a cliff, and they may have been saying it was a bad time to buy. But if you bought and held single-family rental properties in 1982, you would have profited from this handsomely because you would have seen higher home price appreciation in the years, higher than normal home price appreciation in the years that followed. And that's what's likely to happen here as well.
So if I'm an average investor on the street, I don't have this data plus perspective. I'm thinking, you know, interest rates are high, not a good time to buy. Not your average investor sees interest rates are high. They've been high for a long time. The coil is wound real tight. Right now may be a good time to buy because if I get in now, this coil is going to uncoil here at some point soon, we expect. And that's going to lead to this like above average home price appreciation that I get to like take advantage of.
Well, yeah, here's the thing, guys. This is a time to stay the course and follow the plan that you have. And the plan for many of you is to follow your buying plan and continue to add properties according to your goals.
For existing JWB clients who have a plan built for them by the team.
Exactly. I'm kind of speaking to our current clients right now. So this is a time to separate that noise and just simply follow the plan. You came to this asset because of the fundamentals, because of the consistency, and don't let that deviate you from your plan. So many of you have a plan to continue to add rental properties. And what I'm going to tell you here, guys, is we're going to look back 10 years from now. And guess what? We're going to see home price appreciation levels on average over those 10 years being right around 4.8%. It doesn't matter that we have had through 6 months this year a 1% decline in home prices. The more important thing is that you chose this asset class for a reason. You chose to work with a provider who has significant perspective and experience in this asset class. And it's time to just rely on those fundamentals, stay the course, and follow that plan.